You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. So last week we looked at a very well-named strategy. It was the RBG Butterfly, based off of the news this week that we lost one of the icons on the Supreme Court, Ruth Bader Ginsburg. We had a little bit of movement in a lot of the healthcare companies, and we just kind of talked about how on United Health Group Incorporated, UNH, that the stock really got beaten up for no real good reason, besides the fact that there was some concern about what might go on in the court now that RBG has passed. So in honor of her, if you will, we did a bullish butterfly trade. Now, once again, it wasn't meant to be a recommendation. Everything that we do on Options Playbook Radio is intended to learn. And we mentioned on the call that United Health Group, UNH, was a $312 stock at that point in time. And, well, $300 stock when we were talking about the trade. And because of that, the options are inflated just in general. So we wanted to do something where we could take a fairly inexpensive shot to see if we could get a little bit of a bounce back on the underlying. It was a trade that you didn't necessarily need to manage if you put it on, because we were going to do it for a very limited risk overall. So what we were looking at last week on Options Playbook Radio, we had United Health Group trading at $292 approximately and a little bit of change. And we went out to the October 16th expiration, so it still has some days to live. And we bought the 310 strike call. Then we sold 2 of the 320 strike calls, and then went out and purchased one of the 330 strike calls. That was our hedge. And we were able to get that entire trade done. Well, the midpoint, the market was closed at that time. So we said the midpoint was right around $1. So you had a 10-point wide butterfly. You're paying $1 for it. And you were hoping that the underlying could move at least the expected move. And I think we did the math on that. We said the expected move was right around 13. So we were at 292. So we were within that range. We weren't that far away overall as far as where we picked our strikes at. We were looking for about an 18-point move. And lo and behold, we've received that. Today, I took a snapshot of that trade at about 1 o'clock today. And I should mention that we are taping Options Playbook Radio. It is September 30th. The markets are still open, but we're getting close to the close. And right now, if I were to get a quote just on UNH outright, not when I actually took the copy of the tray of the actual butterfly that we were looking at, but UNH right now is currently trading at 310. It's up $5.88. This morning, when I just took a snapshot of the trade because I knew I was going to talk about it today on our show, the stock was trading at $8.59. The last trade on it was $312.74. And if I took a peek at that butterfly, the midpoint of the butterfly was $2.29. Now, I'd rather talk about it with that underlying stock at that price because now a decision could be made. And we talked about the fact that if we doubled our amount that we paid for this, if we were able to sell it for $2 or more, that we'd probably want to think about getting out of the trade. We weren't trying to get a home run here, and I don't think a butterfly trade is that, where you're saying, okay, the width between the strikes and the butterfly are 10 points. I'm hoping to sell my butterfly for, $9 or $10 because that's the maximum trade. No, when you're doing a butterfly, it is a trade that doesn't mind time decay. If you're correct on your forecast, it doesn't mind if implied volatility comes down, because if you're correct on your forecast, that means that the underlying stock is approaching your short strike. And in this instance, that would be the 320 strike call. And we've sold 2 of those option contracts. So in order for that to max out, you're better off if it actually approaches that 320 level closer to the expiration date. So now, if I was doing this trade, I would have definitely considered getting out. I'm up more than $1. I'm up more than 100% on my investment. And the stock has quite a few days to go until that expiration date. So when we put on this trade, it was obviously a week ago, as opposed to when we're taping it right now. And that expiration date had quite a few days remaining. If we look at our trade, we see that the October 16th expiration date, considering it is the 30th of September, still has 16 days remaining. And we've had that underlying stock become in the money, so it's made the move sooner rather than later. And since we have a long time period, we've already made a decent amount on the trade, I would definitely consider just getting out of the trade. Now, if you do think that it can go up, if you do think it still has a little bit more upside, maybe you wait a week and you give yourself a little bit of time decay, but I'd be very conservative on the downside. Right now, with the midpoint on that trade being at $2.30, if it came down and let's say it got down to $1.50 or something like that, I still want to make sure that I keep that gain because I've already been correct on my forecast, and I would hate to leave this trade and not actually make some money on it. So that's how I would approach that trade overall. The fact that we have 16 more days to go to expiration, we were right sooner rather than later. That kind of hurts the profitability of it. But then again, it's a profitable trade, so don't look a gift horse in the mouth. All right, so we focused last week on why we wanted to do a butterfly on a fairly expensive stock that we think could pop a little bit to the upside, and how we could take a fairly inexpensive speculative trade on that underlying stock. And I want to do the same thing this week. And it's all based off of current market conditions. And that's what we talk about here on Options Playbook Radio. So we are getting into the earnings season. And if I look at the airlines, they're going to be announcing, a lot of the airlines are going to be announcing in the mid to end of October. And one of the ones that I'd like to talk about today is Southwest Airlines. The symbol is LUV, and they're going to be announcing before the market open on the 22nd of October. Now, you might be saying, well, that's quite a ways away, and that it is. And one of the things that I want to, or the strategy that I want to talk about, likes the fact that it's a little bit further out in time. We're going to talk about a long calendar spread using puts in LUV. Now, we're going to do it using out-of-the-money puts compared to where the current underlying stock is at, because we're just going to take a little bit of a bearish tone to it. But earnings are a big deal in the airlines. I see that's when the one time where you're getting some information about what's going on in that travel industry. So If you wanted to, you could do it on the bull side. You could look at calls and go a little bit out of the money, and you could duplicate this. But the reason why we're talking about it is the fact that implied volatilities have been high in the airlines ever since the pandemic has been announced. They've never really came in. So the front month option contracts are trading at almost the same amount of implied volatility as the back month option contracts. But we have earnings. So the October 23rd expiration, the option contracts that expire the day after the earnings have been announced. And by the way, so you have the 22nd is a Thursday, so you have all day Thursday, all day Friday for the underlying stock to trade after that announcement. And if I look at that, we see that the implied volatilities have gone up a little bit, but they're trading at about at the midpoint right now. I'm seeing them at about 56% implied volatility. Now, the underlying stock, the market is open and it's trading at 37.54. It's basically flat on the day. And that's kind of what we're looking for on the strategy is if the underlying stock can just kind of wait around until earnings, we want to look at a way to get long a put option for a fairly inexpensive price. That's our goal here, and that's why we're talking about this trade. So if we do this trade, what we're expecting is the back month implied volatility or the October 23rd expiration, the one that we're going to be buying, we're hoping that implied volatilities will increase on that option contract. And then on the front month, the expiration that we're going to be looking to sell is the October 9th expiration. It has 9 days remaining till that expiration date. And we're hoping that implied volatilities will come in, but we definitely know time decay is going to happen, right? You're in that sweet spot as far as time decay is concerned, and that in the last 9 days, you usually see quite a bit of decay. So let's get into the strategy and talk a little bit about the debit and our goals of this trade. So as I mentioned earlier, we are taping Options Playbook Radio on Wednesday, September 30th. The markets are open. Right now, we see Southwest Airlines. We take a snapshot of it. It's trading at 37.54. It's down about 8 cents. We're going to go out and buy the October 23rd expiration 36 strike put, so a point and a half below where the underlying stock is at, and at the same time sell the October 9th expiration 36 strike put. Our goal here is to have the underlying eventually go down. We don't quite know when. It's okay if it waits until the earnings date before it decides to make that downturn. But in the short term, we're kind of hoping that we can use the credit from selling the shorter term option to help pay for our longer term option. So if I look at this trade, the midpoint right now is 84 cents. So once again, a fairly inexpensive speculative trade that we're looking to do on Southwest Airlines going into earnings. If we were to just buy the 36 strike October 23rd expiration outright, I'm going to give you approximately the midpoint, about $1.40. And we're going to be paying about 58% implied volatility. Now, by selling the nearer term option contract, we're going to get around 56 cents to lower our overall cost. And we're still receiving about 50% implied volatility. So we're still getting some juice for that option contract. And hence the reason why I think around earnings on some of these travel stocks, this is an interesting strategy to try to implement. Now, that said, I suggest that you definitely do this on paper, especially if you've never done a calendar spread or a time spread before, because they do get really tricky in the fact that you can't fall asleep at that first expiration date, that October 9th expiration date, because you might have to do something. So if I put this trade on, I'm definitely going to set an alert and say, if this underlying stock gets to 36, I want to know that it's at that range, because my whole goal here is to put this trade on and hopefully the stock drifts down towards that 36 level and doesn't get there before the expiration date. Now, if it did get there and it was trading at 36, I would probably just take the trade off. I should have a small profit on this trade, but it should be a profit nonetheless. I mean, and by small, I'm talking maybe 30, maybe 40 cents on a 80-cent trade. On a percentage basis, that's a big profit, but I'm okay with that. And I just don't want the risk. I don't want this market to go below 36, because once that shorter term option contract gets in the money, it's going to work hard against me and against my longer term option contract. So I want to be aware of that. Now, if it doesn't quite get there, or the market goes up, which would be a bad thing overall, we would then definitely be losing on our position. I can decide, do I want to manage this? If I am down on this trade, let's say I lost half of the net debit paid, so it's trading around 84 cents. So if it's trading, now I can just close it out for maybe 40 cents, 45 cents. Well, I can do that, but we're managing our risk by actually doing the calendar spread as opposed to just buying the option. So a lot of people would take the approach that, okay, it's going up. I know the short-term option contract then will expire, and let's just ride the put into earnings and see what happens with that trade. So I guess let's summarize it one last time. We're looking at a long calendar spread with puts on Southwest Airlines. Southwest is going to be announcing earnings on October 22nd before the market opens. We're going to be buying to open the October 23rd expiration 36 strike put, and then selling to open the October 9th expiration 36 strike put. The midpoint as of right now is at 84 cents. So this entire trade at a net debit to the account of 84 cents would be $84 plus commission. And that would be my risk all the way up until that first expiration date. And then it depends on what I do with it from that point on, if I just leg out of the trade or if I decide to close it out early overall. So we've managed our risk by buying an option contract that we really want to own but has inflated implied volatilities, and then selling an option contract that's still trading at inflated volatilities, mainly because of the way the markets are. All right, so that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can always send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.